green bond early on really became a communication vehicle, a way in which you could communicate both your sustainability strategy and really identify projects that you were doing to advance your sustainability agenda.
Back in 2015, you were teaching people for the first time, what are green bonds? How do they work? Why should you do a green bond? What are the benefits? What are investors saying? Many treasurers, CFOs had never heard of this product.
Part of the obligation on green bonds is that the issuer is required to report back to investors on what they did with the money and its impact.
The earliest green bonds carved out nuclear. It was an exclusion when those deals came to market. But we were one of the first and maybe one of the only banks who were having extensive dialogue with market participants on the benefits of nuclear, why we think it should be considered green.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. In 2010, you moved to cross-asset structuring as the head of green bonds. That sounds like an interesting move. Green bonds was a pretty new concept back then. So how did that come about?
So I was in interest rate sales, as you know, and that's why I have such a tight connection with a lot of the socially responsible investors. But when I moved over, I didn't actually move over as head of green bond sales. Reality is I moved over as a cross-asset structurer. And because I had such tremendous experience in interest rate sales, as well as other products from corporates to mortgages, I had a lot of experience. And the mandate of that cross-asset team was actually to help construct trades and trade ideas to break down the silos in the bank. So we had an interest rate sales team, an equity sales team, an FX sales team. And so they were all very siloed throughout the bank. And the concept and what they really wanted to do, because I had sold almost every asset class that we had, is they wanted me to work together with really a bunch of quants who were really looking at correlation and studying the correlations. So what I started doing was really helping them construct anything that was 2 standard deviations from the mean in terms of opportunities, and really helped construct trade ideas that would provide hedges for some of the correlation trade. Because remember, during the 07-08 financial crisis, or the correlations blew up, everything went to 1. And so really what we did is spend a lot of time looking for opportunities for our clients, either hedging or those that wanted to take a bet on trading the correlation. And it was while I was sitting in that seat, I was also helping work with some of the multilateral development banks who were trying to access and diversify their investor base. What did that really mean? Well, most of the multilateral development banks sold a lot of their debt to either pension funds or central banks globally. And so I knew them very well from my background in interest rate sales. But what they really wanted to do was diversify their investor base. And so I started structuring trades for them, everything from Fed fund floaters and unique things that only US investors would buy. And so that's where I began to really get to know a lot of the investors, even just outside the central bank community, to provide and structure some of these trades. So it was IFC that it was there that I did a bunch of these trades for them. And I said, well, what else are you actually working on? What else can we help you with? They said, we have this little program in Scandinavia that gets a little bit of traction, but we can't make it grow. It's not really working very well. Do you think you can do something with this? And they're starting to call them green bonds. And I honestly was not involved at all. And so I said, I tell you what, let me do some research. Let me spend some time working and talking with investors. And it was there off my desk on the structuring desk that I wound up working together with the IFC for the first benchmark green bond, which was back in 2012, right off my desk. And it was there. That was a 500 million benchmark transaction. And then the market started to really take notice because the green bond market wasn't new. It just couldn't go anywhere. Couldn't get any lift. So that required a lot of work to develop an investor base. I mean, I must have defined what is a green bond, a million times in the beginning. And we had a core group of US investors, 10 or 12 of them, that said, yes, I'm in. I like the concept, mitigating risk, targeting opportunities to align with at the time we called it socially responsible investing.
Yeah.
And so there we did the first benchmark green bond. And it was there that the market really started to take notice what we were doing, because until then, it was largely pension funds and insurance companies with very small tickets in Scandinavia and a small amount of issuance in the Yuridashi market in Japan, which is the Japanese retail market.
So you were really around right at the birth of the green bond market. And you then became a co-author of the Green Bond Principles. So you've received multiple awards for your work in the green bond space. You were called by Reuters Wall Street's Green Bond Warrior. That sounds fierce. Personality of the Year by Environmental Finance in 2019, and ESG Financing House of the Year by International Financing Review in 2021. So I want to speak a little bit about the start of the green bond market and your work on the green bond principles. But first, I'd like you to explain what green bonds are and how they differ from traditional bonds, just because there are probably some people who are not familiar with this concept.
Sure. A green bond is a debt instrument that fixed income investors participate in. It differs from a traditional bond in that a traditional bond, the use of proceeds is generally written as general corporate purpose, which means they can use the money for anything they want. There's no limitation. There's not really any guidance on what they intend to use the money for. And the unique approach for a green bond is two basic differences. Number one, a commitment of an issuer of a green bond commits to providing information on the intended use of proceeds. And that early on, it was green, I think we called it environmentally friendly purposes. It was very generic, early on. And so it was then when we worked on the green bond principles that we really began to delve into, okay, we know it's environmentally friendly purposes that we all agree to, but what does that actually mean? And this is where the core of the development began. How do we guide the market to ensure that we put guardrails, to ensure that people don't push too far or step over the edge, and we don't ruin this burgeoning market that we've begun to develop? So it was actually at the Environmental Finance Conference in 2012. Suzanne Bukta from Bank of America and Mike Eckert from Citibank and I got together. And it was there that we began to say, look, because we had all been working on a variety of trades on our own. And so it was there we got together and said, this really has some legs to it. I think there's some real opportunity here. And it presents an opportunity for investors to earmark and to target investments that suited their asset owner need, their asset managers. And so it was there that we began to work on, and later someone, Tanguy Clockwin from Crédit Agricole got involved. And the four of us were generally the core co-authors of the document you now know as the Green Bond Principles. And over time, we had participants from others in sustainability within our firms that joined us and worked with us. But I think the success of the development of the Green Bond Principles is that you really had four bankers working on this, not the team in sustainability. Because the thing about the bond market as a general rule is there's a few very important elements. It needs to be simple, it needs to be liquid, and it needs to be big. And that is what most strategic investors wanted. Well, the green bond market up until that point in time was anything but that. It was niche, it was small tickets, it was completely illiquid. And so the benchmark deal that I worked on by myself really set that stage. And as of it, I think Suzanne was working on the Bank of America transaction. Mike had been working on renewable energy. So together it was quite a team, but we all really worked we all were bankers. We weren't sustainability experts. And so Camilla Seth was the person at JP Morgan that provided a lot of color and background and some sustainability expertise. What happens is, as you think about these markets and you begin to develop what is green, that's where the market really changed. And that's where the principles that you now know, or the market has well accepted as the standard, became critical for the further development of the market.
So in your explanation of what the green bond is, one thing to make sure it's clear to everyone, the proceeds are ring-fenced to certain uses as opposed to a traditional bond, correct?
I would use the word earmarked, not ring-fenced. Ring-fenced is a very specific term. So when an issuer comes to market with a green bond, what they do is traditionally they will establish a framework document. And that's what many of us in the sustainable finance or the debt capital markets would do, would help the issuer provide a communication narrative on their sustainability strategy, their goals, and then communicate to investors the eligible project categories they would intend to use. But there is no covenant in the bond. And I think this is very important. It is a commitment that an issuer will make, and they will report back to investors on exactly what they did for the money. But there is no covenant actually in the document. And early on, we met with quite a lot of pushback from some of the environmental community who basically said, you're not going far enough. But early on in the green bond market, when we were developing the principles, it was absolutely critical to make sure and remind ourselves consistently that perfect was the enemy of good. And we wanted to make sure that the approach we took was an approach that was credible, but it also provided flexibility. Because remember, what we were creating was a standard that could be used globally. And there were SEC registered bond markets. There was the Reg S market, which is the Eurobond market. Very different legal rules on how that approach it, what one could put in a bond document and what you couldn't, what could be outside the documentation and what didn't. So it's quite technical. Again, one of the benefits that all of us were heavily involved in debt capital markets and understood both investors' needs, but also the bond market. That's how it evolved.
What are the benefits or incentives to a company that issues a green bond versus issuing a conventional bond?
So if you're a company that has a sustainability strategy, one that wants to communicate and share that strategy with their broader stakeholders, and that includes banks, it includes their investors, shareholders, it includes a broad group of stakeholders. The green bond early on really became a communication vehicle, a way in which you could communicate both your sustainability strategy and really identify projects that you were doing, both CapEx and OpEx, to advance your sustainability agenda. And that was actually really quite important for the market. It really hadn't been done at this time. So investors could really see a very clear path of where that company was going from a sustainability perspective. That was really the benefit. And we could argue that early on, the additionality, if you will, of the green bond market really, or the concept of additionality, needed to be redefined with respect to green bonds. Because the idea was not, additionality is often defined as if not for this financing, then the funding wouldn't happen. Well, that's actually not true, because a company could fund a green building with traditional debt if they wanted to, and didn't need it all to use a green label for that transaction. But what it did do is it really communicated the importance of spending and raising funds for the development and for climate mitigation and adaptation. And that's really what spearheaded the market. It was really more of a communication vehicle than anything. And knowing where we are today, I never would have thought we would have have gone this far. I'll be honest with you. We thought it was an interesting opportunity, but I don't think any of us that worked on it would think that it would represent 15% of issuance today. I mean, you have to remember the fixed income markets are massive.
If you'd like to share an insight, a question, or perspective from your corner of the investment world, I'd welcome hearing from you. You can reach me directly at scott@sri360.com. Many of the best conversations on this show begin with listeners like you. There has been the development of greeniums, so to speak, where the borrowing terms ended up being more advantageous than they would have been on a traditional issue. Am I correct on that?
You're absolutely correct on that. There isn't always a greenium, but there often is. And what I would say, and this is the speech I would give any issuer that was considering a green bond, if your priority in doing this is to take advantage of the greenium, this is probably not the right transaction for you. Because investors are smart. We know that. And for them, if your sole purpose was to get 1 or 2 basis points, whatever minor benefit grow greenium for this transaction, then it probably is not the priority for an investor. They really are looking for a sustainable strategy. They're looking at a company that's looking to the future, that is looking to decarbonize, that is looking to build sustainable buildings, that is looking for opportunities to enhance biodiversity. There are a variety of things, and that was a very forward-leaning company. And so investors looked at it from a slightly different perspective. In the end of the day, when a bond comes to market, it's very difficult to say what exactly the greenium was. It is more art than science. If a transaction is brought on a Monday versus a Friday, there could be a basis point or 2 differential on where that would price. If stocks are up versus down, depending upon the issuance calendar, there are a lot of very technical aspects when you're bringing a transaction and it comes from off the syndicate desk. So I think the most important thing, and yes, there have been times there's a greenium that comes and goes in the market, but the priority, I think, for most issuers and for the investors, that was not the main focus and not the reason why they participated in it. I would say that was an added benefit.
Could you give 1 or 2 examples of the types of transactions that were financed with green bonds so that people can understand what type of bonds have been underwritten in this format?
Yeah, so some of the more visible bonds in the market, Alphabet, I worked on that transaction. They issued $5.75 billion sustainability bonds. So they were a combination of green and social projects. And those types of projects could include renewable energy efficiency, water savings. For example, when you have a lot of use of data centers, they use quite a lot of water. So using measures and opportunities to reduce the water, to power your computers with renewable energy. But also, I think, in that example that I gave you for Alphabet, the use of proceeds also includes social criteria. So the social criteria include things like affordable housing. Also, they looked at projects that would help broaden and expand opportunities from a diverse set of players. So looking for opportunities for diversity, equity, and inclusion. And so they would have programs that would help build this out. So that was done many, many years ago, but it was important in the market. The other thing that was very popular was utilities, because as you could imagine, if we look at the US market specifically, many of the utilities a decade ago, or maybe even a little more, the electricity was probably generated in North America by 60 or 70% coal. So it was very important over time to build out renewable capacity. So many of the early green bonds, and still to this day, are done by utilities who are building out their capacity for wind and solar.
Since you're a co-author of the Green Bond Principles, what was the main problem you were trying to solve?
Well, what I would say is most of the co-authors were rather long in the tooth. So we had been around a long time. And so you see a lot of things. And I said early on in our conversation that there is a benefit to watching how markets rise and fall. and you see what happens. And without any standards in the market, and the Green Bond Principles are voluntary process guidelines for best practices. So we provide eligible project categories to give guidance to issuers. But the definition of green and how one communicates what a green building is was left to the issuer to define and communicate that. So what we were trying to do was make sure that the market had, to some degree, some guide rails, some guidance. So we didn't have some participants ruin the market, because we really saw tremendous potential. And we had watched the CDO market and the CDO squared. We'd all seen many of different markets rise and fall. And so with that, you say, wait a minute. If we really like this market and we really think it has legs, and we really think collectively that there is an opportunity to really provide our investors, because in the end of the day, what do banks do? We service our clients, we service our issuers, and we service investors. And if we really feel we have an excellent opportunity, we want to make sure we publish some guidance. And that guidance then will make sure that people understand what the guardrails are that we intended as we began to explore this market. And so the other thing that we did, we published the principles in January of 2014, and we did two things. The first thing we did is the four of us, of course, as I mentioned, drafted them with our colleagues at the bank. But what we did was we offered to the broader investment banking community, right before the press release went out, if they wanted, they could become on as a signatory, so that it would be an announcement that included, I think we had a total of 25 the first time we announced that. And we actually announced the principles on the series website, so that it was a collective view of the market from the debt capital market teams across the industry. And it was largely, I think there were a few out of Japan, but it was larger Europe and US banks at the time. And that was important. And then shortly after that, we immediately worked on a governance document. And that was part, again, I think it was Mike Eckhart who had a tremendous amount of board experience at that time. And so he kept us following Robert's Rules of Order, and we're quite strict in how we approached and developed the governance document, which has evolved, of course, from the original document that we published. I think it was at the end of the first quarter after we published the principles.
We're 10 years on now from the time that you started working on the green bond principles. Give me a big picture on ESG bonds and tell me how this asset class has expanded over this time, from what was originally just green bonds to include social bonds, and then sustainability bonds and sustainability linked bonds. How does it look now?
So it's been an evolution, just as you said. We started with green bonds. The question is, how do we define climate versus green? And I think that's actually a very interesting question. And we often talk to Sean Kidney, who is the founder of the Climate Bonds Initiative, and we often would try and go back and forth. How do we think about the two? And I would argue that green is bigger than just climate, because within that, we are looking at other things like sustainable water projects or biodiversity and other things that are not just about CO2 emission. Pollution prevention and control, we're worried about many of the other emissions and pollutants and effluents that are coming out of systems. So that's the first thing that I would say. And then over time, we had really started with the multilateral development banks, where they had projects that were really aligning with the Sustainable Development Goals. And they were looking at social projects, which included everything from affordable housing to access to finance or healthcare, education, a variety of those things. And there really was an appetite. Again, I come back to servicing our investor base. We always want to make sure we're not just innovating products that don't have a need. And there were investors that were really quite interested in trying to identify and put money towards improving the social agenda. And it largely started and followed on the Sustainable Development Goals. And so we then created on the executive committee of the Green Bond Principles, which, by the way, I just want to say one thing about it. It is equally made up of issuers, investors, and underwriters, which are the three key market participants in this market. Doesn't include anybody else. Now we have advisory committees in which other participants will provide feedback. We have annual consultations where people have an opportunity to communicate what they want to see in the next iteration of the development of the market. So social projects and the Sustainable Development Goals became an important issue. And the multilateral development banks were making quite a lot of loans, particularly, of course, in the emerging markets where they operate, to help this agenda. And so we developed the social bond principles. And then over time, we had some issuers that, hey, I'd like to do green and social projects. Now, green and or social projects. So your projects can be green, or you could have projects that are social. So they could be green and or they don't have to be green and social, because that hurdle just was too high for anyone to meet. And so that's how that came about. Now, the sustainability linked market is quite different. It's very different, as a matter of fact. And the origins of that market really started in the loan market, or the RCF market, revolving credit facilities. And some of the challenges with that market is that there was no earmarking at all of the use of proceeds. However, what the issuers would commit to in their facilities is they would commit to improving certain, what we call KPIs, key performance indicators. And they would set annual targets or sustainability performance targets of things they would want to achieve. And in this market, which is largely a 1-year, 3-year, and 5-year market, it's very short dated. And so the goals were generally quite small by comparison to the bond markets. The bond markets, we were doing 10-year bonds, 20-year bonds, 30-year bonds. And so that was quite different from loans. Loans, you had a very short amount of time to affect change and to achieve some kind of target. And so you would see very minimal difference, both in terms of 1 basis point or so penalty for achieving or failing to achieve an objective. And so we started with the sustainability linked loans, and then we, of course, brought that instrument over into the sustainability linked bonds. And I worked on the drafting group for that document as well. There were 5 of us on that drafting committee, and they're largely what you see today. And then the loans, of course, adapted to a lot of the elements that we put in there. But I think that the most important thing about a sustainability linked instrument, whether it's a loan or bond, is you can use the money for anything you want. That was not an important element. But what was important was the priority focus on the footprint of the issuer. By that, they mean the overall company and your narrative, your transition narrative, and what you are aiming to achieve, and holistically within the company. So if you're going to cut scope 1 and 2 emissions, or your goal is to cut scope 3 emissions, you would set that target. In the loan market, it was very common to see accident rates going down, or setting goals around accident rates. If you're a manufacturer, accident rates are quite important. Or if you're looking at, let's say, gender diversity or gender pay, a variety of these things could really be included, and some of those goals really could be achieved on an annual basis, and you could affect change. And so the principles were important to establish that the KPIs, the key performance indicators, were material, core, and relevant, and that the sustainability performance targets were ambitious. And that was actually quite important.
So what is the role of bonds and fixed income in driving long-term sustainability agenda and impact for your clients and ultimately to society? I've spoken with some investors who are critical and saying that as a debt holder, you don't have the same ability to influence or impact as an equity holder does. And others say that they're not convinced that green bonds have necessarily brought into fruition impact that wouldn't have occurred if there wasn't green bonds. How do you see the role of bonds and fixed income in driving impact?
So first of all, fixed income is largely a refinancing instrument. Bonds are refinancing instruments. Let's be clear. So that's why in the beginning of our conversation, I defined additionality, which is really what you just described. Do green bonds have or not have additionality? And then most people use the definition that came out of the Kyoto Protocol in 97, where additionality is defined by the financing of a project that would not automatically or would not have or received the funds. So that project would not have in fact happened. A lot of discussions about additionality when we talk about voluntary carbon markets and many other things. I think when we need to think about green bonds, we really need to redefine the concept of additionality and to think of them more as a communication vehicle and an earmarking to really share with stakeholders and investors on where the company is going. That's first of all. And second of all, they will, in their framework document, a green bond issuer, we'll just keep talking about green, but a green bond issuer is required to provide their definition of each eligible project category, which is extremely important on how they do that. Some will use standards that already exist in the market. European, looks at building standards that are already well adopted, well existing in Europe, and they will embed those. And we welcome that on the green bond principles. Wherever you have standards, refer to those standards. That's great. But in the end of the day, it is largely a communication vehicle. Now, you could say, well, green bonds then, by that definition, are not additional, nor do they really had any impact. If that were true, why are sovereigns, multilaterals, corporates, banks, even project finance transactions labeling themselves as green? Why is 15% of the issuance in the fixed income markets have some sort of green, social, or sustainable label on them? That is what I would call impactful. So I think it depends on who you are. Are more projects happening because they are green? Well, I think it depends. Or maybe the communication narrative and the importance of communicating your sustainability agenda to your broader stakeholder community is extremely important. And the green bond is the way in which you do that. Because remember, part of the obligation on green bonds is that the issuer is required to report back to investors on what they did with the money and its impact. I think we're getting caught up in semantics. If the green bonds were not important to the market, and if they didn't have impact, why is the world so interested in both issuing them and buying them? If what you're arguing is they have no impact, then why, after 10 years, probably a little more if you count the niche market, but why 10 years since we published, we just celebrated the 10th anniversary of the Green Bond Principles. If they are not impactful and they are not important in the market and they are not in any way affecting change, then why are 15% of issuance now, coming to market with some sort of green, social, or sustainable label?
What is your view about a company that issues green bonds for financing something that's green, but then using traditional issuances to finance, let's say, so-called brown activities? To your point, if it's a communication issue as opposed to something that definitively brings something into being that wouldn't have been financed otherwise, I guess some cynic could argue that this is PR, so to speak. And not necessarily substantive.
Yeah, but we have very smart, sustainable investors in the market. That's why I get back to where I said greenium is not important. It's not the most important thing for anyone. And if an issuer is issuing a green bond solely for those purposes, there's no point in doing that. It's just investors see right through that. So you're right in that we need to be mindful and that issuers, over time, the markets evolve. And early on, we really concentrated on the assets only. We really said, even if you're a utility that's largely or is largely coal, if you're developing wind and solar projects, then we want to make sure the green bond market is open for you. But then over time, we began to be more discerning.
What does greenwashing in the sustainable ESG public fixed income space look like, and how prevalent is it?
Greenwashing is a tricky term. If we think back earlier on in the green bond market, and you had somebody who was, and there are a few examples of some less than ideal transactions that are largely fossil fuel, or an oil and gas company that does a green bond and earmarks the money for energy efficiency on fossil fuel facilities. That's pretty much dead on arrival. Investors strategically want to see a change in the business model. So there are some examples of less ideal transactions, and those have been certainly accused of greenwashing. I think it was Planet Tracker put together maybe a year or two ago a really interesting discussion on the various types of greenwashing, because we no longer define it as someone who's issuing a green bond that's not so green. We now define it in a myriad of ways: green hushing, green shifting, green crowding, green rinsing. I mean, there's a myriad of definitions, and I strongly encourage your listeners to go and look at the piece that Planet Tracker did, because I think it's actually quite interesting.
This was Planet Tracker that published this, you said?
Planet Tracker did that. It was a couple of years ago, maybe 2 years ago. And they published it. It was really quite interesting. I thought they encapsulated it quite well. But I think the best way to think about it in all of these contexts is a non-credible approach to communicating your approach to sustainability and your targets and the way in which you plan to achieve, the method in which you achieve those targets to mitigate climate change. I think that's the best way to define it.
In 2015, you make this pivot into JP Morgan's ESG debt capital markets team, and you were one of the founding members. So how did that come about at a point in time when sustainable finance was still relatively niche and not really the in place to be?
So at the time, I was sitting in the equity derivatives team, and the head of the green bond team, ESG capital markets team, was within the same larger team that I was on. That team needed an analyst. And so I was asked if I would be interested in interviewing. And while I enjoyed what I was doing in equity derivatives, frankly, I didn't love that job. I wasn't thinking, yes, this is absolutely what I want to do for the rest of my career. And so I did the interview, did some research into sustainable finance, and it seemed to me like an area that was growing. It was fascinating from the sustainability perspective. It really was a leap of faith at the time to go to this team that was small and was growing, but it was not the normal path or the traditional path in finance that going into my career I had thought where I would land.
The ESG market in 2015 was more near the juggernaut it would eventually become. Paint that picture for us. What was the reality of sustainable finance back then, and especially in New York? And what were the biggest misconceptions people had about it?
Those early days, it was a lot of education. We were going and pitching every single client, and there was so much education that needed to be done to showcase to our clients, who are the issuers, right? The corporates, the sovereigns. What are green bonds? How do they work? Why should you do a green bond? What are the benefits? What are investors saying? Today, when you go to clients, all the banks have been pitching these clients for the last 10 years. So everybody knows all of that, right? Most people know our client base, everything that I just described. But back in 2015, you were teaching people for the first time. Many treasurers, CFOs had never heard of this product. Or they'd say, oh, maybe I heard about it once. How does it work? And so the time was spent not only educating, but pitching on, why this bank, why are we best suited to help you with this product. So it was also very heavily focused on the sales and the business development and ensuring that we're methodically pitching all of our clients from a pipeline perspective. And those early days were key, and I think what would lay the groundwork for sustainable finance to come from a bank perspective.
Building up something from scratch is incredibly difficult. What were the struggles you faced during those days, and were there moments of doubt?
I never had a moment of doubt. No. I think our mission was clear and what we were trying to grow was clear. I was very fortunate to have an incredible mentor and manager who was leading the team at the time. And those early days, it was, I'd say, a lot in terms of we were just a couple of people and we were covering the whole world. So now today you have regional teams and there are large teams, but there was quite a bit of issuance still, even in the early days from 2015 to 2018. And so you had just a few people on these teams running around and pitching every single issuer globally. That's in the US, we were in Europe, we were pitching in Asia, Australia, and building everything from scratch. So today you have templates of slides and how we do things. Well, in 2015, we had a handful of slides, but so many things were new and we were inventing how to pitch, what's the criteria, how do you write it? This was before green bond frameworks. People talk about frameworks now, right? 2015, there weren't even frameworks at one point. The concept of that wasn't there. So it was very much inventing as we went along.
Not everyone listening knows all about this space. So for those in our audience who might not be familiar, give us the 101 on green bonds. What are they? How do they work? And what made them revolutionary when they first emerged on the scene?
So green social sustainability bonds are use of proceeds instruments where the issuer of the bond is making a commitment to investors to allocate an amount equal to the net proceeds to eligible green and or social projects. And because the proceeds from the bond are actually getting allocated to those projects from an investor perspective, they're viewed as impact investments. They actually know where that money is being spent. And not only do they know where the money is being spent, but more importantly, there are expected impact metrics associated with the bond. So for example, let's say you have a green bond issuer, they allocate to renewable energy, and then they will also report on what are the expected impact metrics as a result of spending that money on a wind farm or a solar farm. Then there's also sustainability linked bonds, which were invented circa 2019, took off more in 2020, where the use of proceeds is general corporate purpose. Issuer doesn't have to spend money on specific green social projects, but the bond is linked via the coupon to a key performance indicator in the future. So if the issuer doesn't meet the KPI, then there could be an associated coupon step up.
You led or participated in over 500 sustainable debt transactions during your time when you were at JP Morgan, including some groundbreaking deals like the very first high-tech green bond, which was issued by Apple. That must have been groundbreaking at the time. What were the behind-the-scene challenges of making that happen, and what did that experience teach you about innovation and finance?
Apple, Amazon, many of the tech deals that we worked on at that time, there's quite a bit of a tech boom in sustainable debt around 2018 to 2020. What was fascinating around those deals is crafting of the use of proceeds across all of the different eligible project categories. So companies such as Apple or any tech company, right? What are they spending green dollars on? It's not only the traditional spends, renewable energy or green buildings, but there are also a variety of ways that they're greening their supply chain and the parts that are going into these products that you and I are buying from Apple or these other tech companies. And then there's also the social side. We saw quite a bit of a growth on the social side around 2019 to 2021.
Fast forward to September 2021. That's when you joined Crédit Agricole as Director of Sustainable Investment Banking. In March 2024, you were promoted to Managing Director, Head of Sustainable Investment Banking Americas. Let's talk, Meryl, about your role as Head of Sustainable Investment Banking for the Americas. What's the scope of your mandate? What are the key performance indicators you focus on, and how do you measure success beyond just the financial metrics?
Our team is set up slightly differently from some of the other banks. We sit within coverage, and sustainable investment banking at Crédit Agricole covers the entire investment banking product suite. What do I mean by that? Most of our time is spent on structuring bonds, green bonds, sustainability linked bonds for our issuer clients. We also spend time on the loan, on the financing side, structuring green loans, sustainability linked revolving credit facilities that can be bilateral loans, syndicated loans. Outside of debt capital markets and financing, we also do ESG advisory across the other lines of business. That includes, in the case of M&A transactions or IPOs or trade finance, supply chain finance, it's anywhere within the investment bank for our clients. How can we provide advisory on sustainability? That's the question we're constantly asking ourselves out of our team. In addition to that, I spend an incredible amount of time with sustainability investors. In fact, on a quarterly basis, we are talking to the top 20 sustainable focused asset managers globally. We have a ESG syndicate team, and since the early years of sustainable finance, right back to 2015, this has always been one of the most important parts for me, because I really believe that if you're going to structure deals in this space, if you're going to bring clients to market with sustainable bonds, you have to be plugged in to what the investors are looking for. It's crucial. And that's why I spend a lot of my time with the investor base also.
I'm always interested in scale and proportion. How large would you say is a sustainable investment operation relative to Crédit Agricole's overall investment banking activities? And has that ratio changed over time?
The way I describe the sustainable finance team is it is intended to be diversified across all structures, all business lines, all sectors, all geographies. So we are not only focused on certain sectors, we are advising every single client in every single sector for all of their products as it relates to sustainability. And that is the case globally. So we're doing this in every single country and city that we have clients in. It is a approach where we are bringing our Crédit Agricole Group strong climate commitments and using our sectoral and geographic setup in order to advise our clients.
Your rail spans across all sorts of financing, bonds, loans, supply chain finance, M&A, IPO, derivatives. That's a lot of different playbooks to master. Which of these areas do you see as having the most leverage for creating sustainable impact?
I definitely still believe on the bond side. I think that has been obviously and will continue to be an important part of impact from an investment perspective. Where do I see the most growth in terms of innovation or new products? I think in the trade finance side, how we can integrate sustainability linked KPIs into supply chain finance is an area that is in its infancy that will grow. Then there's also the question of financing, for example, to debt funds, and how do we integrate sustainability linkage into the financing of credit funds. Also something that is starting to evolve, particularly in the boom in private credit that we've seen over the last few years. So I look at sustainable finance today as in part a continuation of what we have been doing for the last decade with certain tweaks and flavors, differences on the fixed income side, but also how do we better integrate sustainability into some of these products and lines of business that previously were not as expanded upon due to the significant rise in focus on the bond side.
Crédit Agricole was an early mover in the space, probably due to its agricultural roots, but was also co-founder of both the Equator Principles and the Green Bond Principles back in 2003. Now, how does that pioneer DNA manifest in your team's approach today? And has that early mover advantage translated at all into a specific competitive advantage for the bank?
100%. It does impact our day-to-day because Crédit Agricole has been, as you mentioned, Scott, involved in this space since the start. And it is a key focus not only for my team and all of the partners that we work with, but for the senior management of the bank, from a top-down perspective. And that has been the case for decades. You mentioned the Equator Principles, co-authoring the Green Bond Principles, being on the executive committee of the Green Bond Principles for the last decade as well. We were involved when they were first written as the co-author in 2014 when they were published, and that will continue. Our commitments will not change. That commitment towards sustainability is crucial. Does it provide a competitive advantage? 100%. In my view, if I were to put myself in the shoes of an issuer and you have to pick a bank of who to help you structure a transaction. Well, league tables are important. Who has structured a lot of deals? Who has the right technical expertise? Who has sustainable bankers that only spend their time working on sustainable deals? They don't wear two hats. It's one hat. They have different elements of experience. On my team, something that I believe is really important is to have a diverse set of individuals. What do I mean by that? We have people with masters in sustainability. We have people with degrees in environmental engineering, environmental science, people with finance backgrounds. And so it really is a holistic approach from who we are and the people that we've very strategically placed on these teams in order to best serve our clients for sustainability advisory.
Anyone who's listened to this show for any length of time knows I never miss a chance to bring up nuclear energy. And what better time to do that than when I have a French investment banker sitting in front of me. So I understand nuclear energy falls under one of Crédit Agricole's sectors of interest, which I find fascinating since many sustainable investors still shy away from nuclear. Marc Andreessen has said that he doesn't believe that people are serious about climate change because he says we already have the solution, and that solution is nuclear energy. It's cheap, it's always on, and Gen 4 nuclear is safe. But he says no one wants to talk about it, and so he just quits talking about it. But because of that, he doesn't think people are serious about dealing with climate change. And whenever I have someone on this show that's all about renewable energy or energy storage, I always bring this up. And they almost, without exception, say, yeah, I think nuclear should be in the conversation. But honestly, that's as far as it gets. So I agree with Marc Andreessen. Nobody seems to want to talk about it in this venue. So tell me, how does nuclear fit into Crédit Agricole's broader energy transition strategy alongside of renewables? And I know that France is quite different from the rest of Europe and that a large percentage of electricity is generated via nuclear. But are you actively financing nuclear outside of France? And tell me where this fits in and what your activities have been.
We have a long-standing history with our support of nuclear energy. If you think back to say 2020, even before 2020, when there were a lot of market participants who were hesitant on nuclear as it relates to inclusion in the EU taxonomy, inclusion in green bonds. The earliest green bonds carved out nuclear. They did not include it. It was an exclusion when those deals came to market. But we were one of the first and maybe one of the only banks who many years ago were having extensive dialogue with market participants on the benefits of nuclear, why we think it should be considered green. Then you fast forward a bit, and what happened in 2023? The EU taxonomy included nuclear and gas within its taxonomy. And after them, we saw EDF, which updated their framework, which we assisted with, and to include nuclear within their green bond framework. Then we saw, as I mentioned before, the Constellation, first ever U.S. corporate nuclear green bond deal, which we were the lead green structuring agent and active book runner underwriter on. Just last year, when I was at Climate Week speaking on a panel for the tripling of nuclear, there was a coming together of 14 major global banks, financial institutions that pledged their support for the goal of tripling global nuclear energy capacity by 2050 to align with the COP28 declaration. So if you think through the vast change that has happened in the last 5 to 7 years in the sentiment and the tone in nuclear, it's not by every investor, it's not by every country, but there has been a significant shift. I think that will continue. And this is one that we were leading from the start. We've also included nuclear into our own green bond framework. So when Crédit Agricole issues green bonds, that is included within our framework. We are a strong proponent of underwriting these deals, financing, of course, with the proper environmental and social safeguards and criteria, but we have been a supporter since the early days.
I know that the nuclear was included in the EU taxonomy primarily because of France. So it's not like there was this big embrace of nuclear,
No,
right?
yeah, exactly.
The ESG debt market has faced a lot of serious criticism lately. And I saw something the other day in the FT where they cited a study whereby the vast majority of green bond proceeds, this was in the US, and I think it was over a 10-year period, was used for refinancing ordinary debt or financing ongoing projects without any green aspect or any additionality to them. And when I say majority, I think the number was like 98%. What's your honest response to the critics who say this is all just greenwashing?
My response is that way of viewing green bonds misses the purpose of green bonds. And I implore those lines of thought to reconsider, what does the term additionality mean for a green bond? And that's not what the term of additionality typically means. And in the case of a green bond, it's, well, investors have the opportunity for increased transparency to drive their dollars towards specific green purpose. That in and of itself, I would argue, is additionality. Would the transaction have come to market, and would those projects have been financed if the bond was not labeled as green? Most likely, yes, of course. And so that's why I think that there should be a reframe in thinking beyond this linear view of this is what additionality means, and if it doesn't fit this box of additionality, it's not additional. Well, is that really the right way to think about it? I don't think that it is. And should we rethink what additionality means for a green bond, and therefore it is additional? I know it's a bit circular in a way, but I do believe that at the core of the green bond market, it is additional in a different sense of the word.
Then what do you propose is the way we should think about additionality?
I think it's viewing it as additional for driving investment and awareness of different types of eligible spends for green and social projects. For a sustainability linked bond, I would argue additionality means there's more incentive to meet those targets. If your coupon is going to step up and there could be a multi-million-dollar penalty as a result of the coupon step up, the additionality in that case is additional resource and incentivization in order to meet those KPIs as the additionality part of the transaction. Then you come back to the same question, well, to what extent did it incentivize goals that the client otherwise was seeking to achieve? And that will vary, of course, but it does have that financial incentive, at least on the sustainability linked side.
I've had a lot of people on the show that talk about that they won't invest unless the project wouldn't happen without this green bond. If there's some step up in incentives and so forth, if those types of incentives exist, then how do you not end up having charlatans pile into the market and just see it as a cheaper way to finance what they were going to do anyway? And are you really incenting the right projects? Because we're talking about the financial markets, and we all know people say one thing, but at the end of the day, incentives are incentives.
In the case of an investor perspective, and I've never been on the investment side, I've always been on the investment bank side, so I'll preface with that. But from an investor point of view, they have a fiduciary duty to their asset owners to most likely not pay up for the fact that this is considered green unless they were otherwise instructed by their asset owner. And at the end of the day, a green bond, sustainability linked bond, and a traditional bond have the same credit risk. The credit risk is not different. And so that's one element. The second, on the side of additionality, if an investor views that term to only mean the project would not have occurred otherwise, well, therefore, in that definition, not all green bonds have, and some green bonds have no additionality, or some have, say, 50% additionality or 10%, but most likely it's very small if you're using that one specific term. And then also the point of greeniums, going back to that dialogue, I think it's just so hard to determine one way or another.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.